Hey everyone, welcome back to Lulu's Way. This is episode 8, and today we're diving into underwriting, what it is, how it works, and why it's absolutely crucial for your real estate deals. Before we jump in, let's do a quick recap of what we've learned so far. Defining multifamily properties and understanding the roles of general partners and limited partners. Creating an investment strategy that aligns with your personal financial goals. Market research and how to pick the best market for your investment based on economic and demographic factors. Property and neighborhood analysis, Class A, B, C, or D properties or neighborhoods, and choosing which fits your investment strategy. Building your team, finding the right people for acquisitions, due diligence, and asset management, debt and interest and loan types, and the pitfalls beginner borrowers might fall for. We talked about different ways to finance your deals and what to watch out for. Now that we've laid all this groundwork, now it's time to learn how we actually plan for a property's future. That's where underwriting comes in. Let's keep it simple. Underwriting is the process of analyzing a property's financials to see if it's a good deal. It's kind of creating a roadmap that shows you exactly where the property is going over the next 3 to 7 years, or however long you plan to hold it. This roadmap details things like how much money we need to buy the property, and that includes the down payment, the closing costs, renovation budgets, etc. And what kind of renovations are we planning to put into the property? It also sets clear how much rent we believe we can change after those improvements, how we will minimize expenses, like negotiating better service contracts or installing energy-efficient systems, and how we maximize revenue, like increasing occupancy, adding paid amenities, or even parking fees or laundry facility. And then lastly, when and under what conditions do we plan to exit, whether sell or refinance. Essentially, it's like building a business plan for the property. After all, multifamily investing isn't about just owning the building, it's about running a business. Now you might be thinking, where do I get all this information to put into this business plan? Great question. Luckily, everything we've talked about so far feeds right into your underwriting model. Here's how. Market and neighborhood research. We check local rent, sales comps, and vacancy rates in a specific area. This helps us predict how much income the property can realistically generate. Property class. If it's a Class C property in a Class B neighborhood, for example, there might be potential to upgrade it a bit and charge slightly higher rents. Team expertise. Your broker or real estate agent provides comparable sales data. Your property manager can give insight on typical expenses, local tenant preferences, and how to increase occupancy. Your lender can help you understand the financing side, interest rates, loan terms, debt service coverage ratio, etc. Financing details. We already talked about different loan types and the pitfalls to avoid. Knowing your down payment requirements and approximate interest rates will help you shape the budget. All this data goes straight into your underwriting spreadsheet or software so you can start building out your business plan. All right, let's get into the nuts and bolts of the underwriting process and the business plan that results from it. Projected income. Current versus pro forma rents. If the current rent for a 2-bedroom unit is $800 per month, but market research shows units in better condition can rent for $900, that's $100 difference per unit. Multiply that by how many units you have in the property, you've got significant potential income, additional income. Think about extra revenue sources like parking, laundry, storage units, or even pet fees or pet parks. Every dollar counts. Projected expenses, operating expenses. This includes utilities, property taxes, insurance, repairs, maintenance, property management. Basically everything that keeps the property running. Capital expenditures, or CapEx. Budget for renovations or major repairs, like roofs, HVAC systems, or interior unit upgrade. This is how you decide how to create value and potentially increase rents. Net operating income. NOI is income minus expenses. This is the key metric that many investors focus on because it helps determine the property's value. The higher the NOI, the more the property is generally worth. In fact, investors use a formula to estimate how much the property is worth with a certain change in the NOI, financing and debt service. Consider how monthly payments, which are principal plus interest, affect your cash flow? Are you still making money after paying the mortgage? Sale or exit strategy. If you plan to hold a property for 5 years, for example, you might project that you'll sell it at a certain capitalization rate or cap rate. This helps you estimate a potential sale price. Alternatively, you might plan to refinance around year 3 or 4 to pull out some of your equity and pay back the investors. Investors are more likely to choose this option when they anticipate a decrease in interest rates. Investor returns. If you're working with investors, LPs, you need to show potential cash-on-cash returns, internal rate of return, or however you structure your deal. This helps everyone see how much they can make and whether this aligns with their own goals. By the end of this, your underwriting should tell a clear story. We're buying the property for X dollars, renovating it for Y dollars, expecting rents of Z dollars, and hoping to sell or refinance at a certain point, resulting in so-and-so profit for everyone. Let's walk through a live example of an underwriting. Just a quick heads up. The documents I'm going to show you are not from a real property. In the real world, these kinds of materials are usually protected by non-disclosure agreements. So for educational purposes only, I have created sample documents that look and feel realistic but are not tied to an actual property.
When you're just starting out, it's easy to think that analyzing a multifamily property is as simple as checking how many units it has and how much rent it brings in. But as professional operators, we go way deeper than that. We don't just hope a property will hit our financial goals. We verify it. And to do that, we start by digging into actual documents that show us how the property has been performing. One of the first documents we request is called the T12, or the trailing 12-month financial statement. This is basically a breakdown of the income and expenses for the past year. We go through it line by line, looking for patterns, inconsistencies, and anything that raises questions. It's like putting on detective glasses and asking, what's really going on here? Now, not every T12 is clean and fancy. Sometimes the seller's management team hasn't been super organized, but we still push to get everything in writing. Why? Because we only underwrite based on facts and not feelings. Next, we check out the rent roll, which is a snapshot of all the current tenants, who's paying, what, and when. Then we compare that to the T12 to make sure the numbers match up. Once we're confident those figures are reliable, we move to the heart of our analysis, the underwriting template. This tool is pure magic. It helps us project income, expenses, returns, and build the property's full business plan over the next 3 to 7 years, or however long we're planning to hold it. Quick shout out here, this template was created by Zach Rucker, who's not only an incredible coach, but also a friend of mine. He's constantly improving it and adjusting the processes to keep up with the real-world dynamics of multifamily investing. I'm currently using version 3.7, but if you're watching this in the future, there may be a newer version out there. Just know that this is how it looks like as of today. The underwriting template has several tabs, and the cool part is, once you enter a number in one tab, it automatically updates all the others. We start with the input tab, where we plug in all the property details from the T12 and rent roll. As we do that, we start seeing key metrics at the top that tell us whether this deal is looking strong or not. Then we start layering in real-world data. Property tax numbers from the assessor's office, insurance quotes from our brokers, utility and maintenance estimates from our property managers, loan terms from our lending broker, etc. From there, we move on to the Value Add tab, where we outline our renovation plans and timeline for increasing rents. This is where our vision starts turning into a business plan. Next up is the Rent Unit Mix tab, where we break the property down unit by unit because every apartment might have its own story and might have its own potential. Once that is in place, we check out the Underwriting Data tab, which tells us how much capital we'll need to close the deal, and it summarizes the key terms. Then comes the Yearly Projections tab. This gives us a year-by-year breakdown of how the property will perform and lets us test the deal under different scenarios. What if rent increases don't go as planned? What if taxes or insurances spike? We prepare for all those what ifs here. Finally, we look at the Returns and Cash Flow tab. This breaks down every financial detail, how much an investor could earn quarterly and what they can expect at the end when we sell the property. That's how we as professional operators attack the deal. It's a thorough, methodical process that helps us make sure we're not just buying a property, we're setting ourselves and our investors up to win.
So why put all this effort into underwriting? Because real estate is a big investment, and you don't want to wing it. The more accurate and thorough your underwriting is, the lower the risk of unpleasant surprises, like hitting costs or unrealistic rent projections. Underwriting is your safeguard. It's how you confirm that the deal makes sense and that you can actually achieve those projected rents and that the numbers still hold up, even if something goes a bit off plan. Alright, this is the why, how, and what of the underwriting in a nutshell. Remember all the steps we've taken up to this point: defining our strategy, researching the markets, assembling the team, and understanding financing feed directly into building a solid business plan. Once you close on the deal, that plan becomes your roadmap to success over the next 3 to 7 years, or however long you choose to hold the asset for. But guess what happens once you actually close on the property? That's where asset management takes over, ensuring that everything we mapped out during the underwriting actually happens in real life. So in our next episode, we'll talk all about how to manage a multifamily asset after closing, keeping track of rents, repairs, and all the day-to-day operations that help you stay on course. You definitely don't want to miss it. Thanks for watching this episode of Lulu's Real Way. If you found this helpful, please subscribe to my channel, watch my previous episodes, and keep an eye out for my next one.